What if I told you that the performance of your Index Universal Life policy had very little to do with the actual performance of the index that you're participating in and much more to do with other factors that are outside of your control? One of the reasons I created the IUL Challenge, and what I'm gonna do in this video is I'm gonna explain to you exactly how life insurance companies utilize options and then an options budget and utilize option strategies to create performance inside of the IUL, the cost structure, the fee structure, and everything that goes with it, because this is one of those areas that I think 99% of IUL agents don't even understand this, and they're selling a product that they don't understand. By the end of this video, whether you're an agent, whether you're somebody who's looking to buy an IUL or looking to learn more, you're gonna know more about this more likely than everybody else in your circle. So if you have any questions as you're going through this, make sure you comment in the comment section below. And if you have any questions, feel free to reach out about anything, Chris@Life180. But if you're here for the first time, please subscribe and hit the bell. That way you're notified every time I launch a new video. I'd like to think this is one of the best channels on the internet when it comes to educating people about permanent whole life insurance and Index Universal Life policies. And so that's it. Let's get into it. I'm excited. We'll see you in there. Hey, what's going on, Cashflow hackers? It's Chris with Life180, and this video we're going to be talking about Index Universal Life, how they work, really what are the drivers of the performance inside of an IUL policy. And one of the things that I want to start with here is that there are a lot of people out there that really lean on IUL illustrations, and I know that what I'm about to tell you and show you is going to be a little triggering for a lot of people. My encouragement to people is don't make an emotional jump to any conclusion. Take a step back, even if you gotta watch this video twice, even if you gotta pause and rewind, even if you feel like you wanna throw something at the screen at me to begin, my encouragement to you is to take a beat, really think about what I have to say, because I think by the time I get through it all, you're gonna realize, oh my gosh, this is the truth. I'm gonna tell you right now, these are the things, what I'm about to share with you are a lot of the things that I learned when I was a director of business development for one of the top IUL companies in the country. These are the things that I learned that got me to pivot and stop selling Index Universal Life. So my encouragement to you, I'm not trying to say stop selling, but I am trying to say you better understand what you're selling. That way you can sell it the right way. And if you still have confidence after what I show you in this all working out, well then by all means, God bless, keep going and selling. But my guess is I don't feel like most people, when they learn what I'm about to share, are going to be confident in continuing to sell this product. So here's the first thing that I want to cover. And I think this is a really big thing for most people to understand. Market performance has very little to do with the IUL performance, with the contract performance. Here's why. When you think about it, you got to think about the flow of money. I'm gonna scan down here. So we think about the flow of money in an IUL contract, right? So what happens to the money? The policyholder has a premium payment. That premium payment goes to the insurance company, right? It goes to the insurance company. That insurance company then puts it in the general fund, right? So let's just call this as the insurance company's general fund, because that's where it's going. They put that in their general fund, and then they get a rate of return out of that. Right now, let's call it 4.5%. That's roughly what they get. So that, based on what their general fund gets, creates what's called an options budget. That options budget then goes down and they purchase call options. So there are some variables that you have to think about here, right? So when we look at this, we go, okay, take the premium, give it to the general fund of the insurance company. It's going to create a return. It's going to create an options budget. A portion of this return after expenses, fees, all that stuff is going to go to an options budget. Let's that options budget, let's call it 4% just for the sake of this this video, even though it fluctuates greatly from company to company, and they don't really disclose it with full transparency what their options budget is. So that can be challenging, but just know this is the flow of money on how it works. Then they go and buy a call option. Now, So there are a couple variables here that really play into it. When I say that the market performance has little to do with the actual performance of the IUL, this is why I say it, because you're not ever directly participating in the market. You are participating in an index through the purchase of call options. Now, how do you do that? The budget is set by the general fund. This is step number one to contemplate, right? So what happens is you have, let's say you do a $10,000 of cash value after all things. You have account value of $10,000 after all expenses and fees. So maybe you had like an $11,000 premium or something of that nature if it's a properly designed policy. So you have an options budget of 4%, right? So what happens is they go out and they say, all right, 4%, that's $400. So this is your options budget. I'm going to call it the OB. That's your options budget. So that's variable one. Variable number one is your options budget, right? So, okay, we got that handled. That's variable number one. Now, variable number two is your options cost. Now, there's a couple things going on here. Options costs go up, then the fees go up, right? So the options cost, I'm not going to get into this in great detail, but if you understand this, they purchase the options calls based on, and then the cost is going to have a price to it, right? That goes along with this. And so based on what your budget is and what your options cost is going to dictate how the policy performs. So when we look at the policy as a whole, every IUL policy, I want to come over to this chart that I kind of created. Every IUL policy out there has one of these three things. They either have a cap rate, they have participation rates, or they have spread charges. These are all moving levers that the insurance company can control and pull and manipulate to get the policy to perform better or worse. If you look cleanly and really clearly through an IUL illustration, it say this policy may perform better or worse based on the performance of the index and all the variables. You go look at this. Every one of these companies, now this is one of those areas where there's a lot of manipulation, a lot of misinformation on the internet about how this works. I want this to be abundantly clear. Cap rates, par rates, spread charges, every policy has one, two, or at least one of these or two of these in the policy. Sometimes they have cap rates and a participation rate, but they don't have a spread charge. That's the X. Sometimes they have a cap rate of say 8%, but the participation rate can't be variable, right? Because they all have a participation rate and a cap rate typically. If the cap rate is variable, maybe the participation rate is variable, but the spread charge doesn't exist. Maybe the cap rate is variable, maybe the participation rate is guaranteed, meaning it can't be changed, and so it's not a big deal. Maybe there is no spread charge. Maybe there is no cap rate. They've come up with a lot of no cap indexes. Maybe there's no participation rate, but there's a spread charge of between 7 and 20% or something of that nature. Maybe there's a no cap rate. Maybe there's no spread charge, but there's a participation rate that's maybe 100 to 140%, but it could be lowered as low as 30 to 60%, right? Like, so it depends one way or the other. If the cap rate is variable, maybe the par rate's variable. Maybe the cap rate's variable, maybe the par rate is fixed. And you know, at the end of the day, if you see a check mark here, these are areas where an option could be variable for the insurance company. The X means it's kind of fixed or it doesn't exist, and the policyholder would be protected. But at the end of the day, you'll notice in all of these, there's at least a checkbox that the company can maneuver to create a performance. Now, can't draw blood from a rock. These things are sold on what? Upside potential, and downside protection. So when we look at this, what are we talking about? When we're sold on upside potential, downside protection, how is that the case? It's because if we go back, actually I'm gonna go down here because it's just easier. When we go back to this number here, basically what they're doing is they're saying, okay, if we think about the flow of money, we knew, I'm gonna just go to this board here real quick too so you got a better view. I think that'll just be better experience for you. So when we go to this board here, we know that we have the money, the premium goes into the insurance company that creates this options budget. The options budget is here. So the insurance company isn't risking their money. They're risking the money and they're buying this call option. So the reason that they say upside potential, downside protection is they're using this $400 to buy the call option. That call option is going to produce a result. And how many options they can buy with this budget is going to be based on the cost of these options. So when we look at this, and I'm going to go back to the chart in a second, you can lose this $400 if the market is negative, your call option expires, you lose it, and you still have your $10,000 of principal. That's how you can't lose to market loss. That's how these work in simplistic terms. Now, the crazy part here is, let's say these cap rates, par rates, spread charges, all of these things are levers that can be moved. All of these fees are dictated based on the options budget and the options cost, because if the cap rate was 10% and the par rate was 100%, but they're movable, well, now what happens if the options budget goes up? I'll go option budget, BUD, goes up, it's from 4% to 5%. Well, that would show that it's really good. And a lot of people right now are talking like, hey, the market should do pretty well because options budgets are going up, because fixed markets are going up, the performance of the general funds, the life insurance companies are going better. So instead of having, a 4% options budget, let's call it a 5% options budget, meaning instead of a $400 budget in the example we gave, we'd have $500 to buy call options. Well, here's the problem with that. What happens in an increasing rate environment is typically options markets become more volatile, so options costs go up. And when options costs go up, it can negate the gain here. So these rates will stay flat or continue to drop or get worse, and it's not, listen, the company isn't reducing cap rates and par rates to stick it to the customer. They're dropping them based out of necessity, based on the cost. This is one of the reasons that I created the IUL challenge. And I encourage everybody to check this out. And this is kind of the proof in the pudding to me. With a product that's sold on upside potential and downside protection, how over the past decade during the greatest bull run of all time did IULs, 99% of IULs that were sold underperform how they were sold, which were supposedly conservative illustrations, right? So how is that the case? Well, the reason that happened is because during this time, options budgets kept decreasing because of the rate environment, and options costs kept going up, and it was like the perfect storm. So, and this is going to continue. And why is that? Why do I believe that's going to happen? Because historically speaking, in a volatile market, volatility equals higher options cost. Right? So as interest rates go up, what's that doing? It's putting a lot of stress on the stock market, on the real estate market, on all markets, and that creates more volatility. The more volatility is, the more the higher options cost, and so that's a negative thing. Now, the other thing that's really worked against the life insurance carriers is themselves. In 2011, there were 14 IUL companies. Right now, there are near 70. So what happens if we understand how options work? Options are, especially when you buy a call option, if you understand how options work, you understand that it's a supply and demand product. So the more money, the more demand there is on them, it's going to drive the cost up. That's why volatility creates higher costs, because when there's more volatility, there's more chance for gain, so more big money comes into the equation, and so that drives costs up until the cost hit a level where the smart money goes, I'm not sure if this makes sense anymore. And so what happens is here, now we have near 70 companies. So what used to be 14 companies, now we have 70 companies going in. That means we have literally billions and billions more dollars every single year going into options markets that didn't exist before. So that's creating a whole bunch of stress on the supply and demand component of the options markets. Now, what does that look like? When we look at this, this is one of the reasons why a lot of companies started creating proprietary indexes. One of the reasons I am so against proprietary indexes is because they're dangerous. They're not predictable. They were cherry picked. There are extra fees and other components that go with them. There are other moving parts that I think are not to the benefit of the client. But the only reason, it's a total moral hazard. The only reason these companies created these indexes that are used for nothing except for these IULs or the annuities that would go along with it as well, but it's only used by the insurance company. And these proprietary indexes were only created for the purposes of reducing the options budget. Now, while that may be beneficial from an extent, it certainly makes them so they illustrate better, right? Illustration performance is improved, but remember, just because it illustrates better does not mean it's actually going to perform better long term, hence the IUL challenge with all these IULs that didn't perform. I still have yet one person to take me up on the $1,000, and I think it's because anybody that could do it, and I've had people say, oh, you know, why hasn't Doug Andrews submitted his IUL to the IUL challenge? Because he's got a video out there showing that he's got one example with an IUL that can do it. I think the reason that they haven't done it is because of the fact that if they do it, they know it's going to stem a larger conversation, and that conversation is going to be about, okay, it's good that you had one. I'm happy to give you the $1,000, and I would be, because I'd pay $1,000 to have a conversation about this, because if 90% of his clients are not doing that, well, like, what does that look like? I'm not saying that is the case, but we need to have that conversation. It's easy to cherry pick if you've sold thousands of policies, one policy that has performed well, but I want to look at the whole thing. And once again, I don't mean to call him out, but he's the one who has the video on that in that instance. So that's just kind of where I'm going with this. But I'm talking about anybody that says, oh, I've got one policy. Okay, that's great that you have one, but what about all the other ones, right? Like this, if it's sold on upside potential and downside protection, it's all about meeting your promises. And if they haven't been able to meet their promises during the greatest bull run of all time, what's it going to be looking like for these policies, for the policy holders when time gets tougher, right? And that is what it is. So these proprietary indexes are extremely challenging because, you know, that just, you know, they created them for the wrong reasons. You don't have control. There's too much volatility. It's just a way to bump illustration rates, and those are all smoke and mirrors. Now, spread charges, you know, that's different. That's a way to say, hey, I'm going to be in the S&P 500 index. We're going to charge a 7.5% spread, meaning the first 7.5% earned by the S&P is not going to be earned. Once it starts earning more than that, that'll be credited to the index. They can, you know, a lot of times they can exchange that from 7 to 20%. So if it's at 7% right now, they contractually have the right to move it to 20%. Now, it's not because of the fact that the insurance company is trying to say, let's raise it and keep the more money for us. No, they're not doing that. They're simply doing that because the only determination that causes the performance of this has nothing to do with, does the S&P earn 20%? Does it earn 15%? No, it has all to do with what's the options budget, right here, what's the options budget, or right here, I guess, and what's the options cost. When you understand that those two things end up having this trickle-down effect to all these areas, and whether it's the cap rates, the par rates, the spread charges, just a participation rate, or just a, I guess it would be just a cap rate with not a guaranteed par rate, you know, or with a guaranteed par rate that they can't change and no spread charge, right? So it could be, oh, I guess I have that one right here actually. So right there. So, okay, so we have that. So, you know, when we look at this, it's just the options budget, just the options cost. And so it doesn't matter if the market does really well or it kind of mediocre. These are the two things that drive it. If the options costs go up and the options budget comes down, well, then they're naturally going to have to take the spread charge and they're going to have to increase it, because you can't draw blood from a rock, because it's the combination of the two. How many options do you buy? What are the return of those options in correlation or comparison to the amount of account value that you have? Because that's all what it comes down to. And when you look at those two things, that's ultimately what drives the success of an IUL policy. And unfortunately, I feel like not enough people know this. Not enough people understand how this works. Not enough people understand the flow of this stuff. You got to understand the flow of money inside of an IUL policy. And you know, I was just having a conversation with one of the viewers, subscribers on the channel. He was sending me an email. He was asking me some questions. It got me thinking about this, and I kind of went back and forth with him in email to kind of help him with the conversation. And I was like, you know what? I should just do a video on this and kind of break it down succinctly, because if he has this question, chances are other people have this question, so I'm just looking at the email really quickly as I go here to see what it is. Cap rates, par rates, spread charges. Yeah, and so that's it. And I mean, at the end of the day, this is why when we look at the volatility, when we look at the fact that a lot of people are saying that, listen, the market's getting better. This is one of the reasons, by the way, that I love whole life insurance and not index universal life insurance, because of the options costs and the way that the option strategies are leveraged. If you have a participating mutually held life insurance contract, whole life insurance contract, as the dividend rates go up, you are partnering with the life insurance company, meaning as we get into this, right? As we get into what the general fund return is, this also impacts the dividend, right? A lot of people go, oh, Chris, it's not fair, the IUL challenge. IULs didn't perform, but neither did whole life. Well, no, neither did whole life, because we lived in a world where dividend rates were going down because the fixed market was going down. Well, we live in a world now where dividend rates are going to be going back up very similarly, maybe not as extreme, but very similarly to what happened in the 80s. And there's always a little bit of a lag. There's a little bit of a tail before that starts to happen, right? But the bottom line is, as that rate goes from 4.5% to maybe 6% in a couple of years to maybe 8%, I, for the first time in my career, could see a world where whole life insurance outperforms the illustration because the dividends are going up. That's the environment we live in. You have to understand how these things work, right? And I think once you do, it becomes really, really clear. With IULs, by doing this, because of the volatility, because of the way this works, yeah, even if the options budget goes up to 8%, if the volatility in the market, think about what this will do to the real estate market, the stock market, everything's gonna crash in value. That makes options markets get more expensive as more and more IUL companies, which by the way, IUL is the most profitable product in the country. I just launched a video a couple days ago talking about the cost of IUL being more expensive than whole life, which is a big misunderstanding. A lot of people think that whole life is more expensive than IUL, but I did a video showing that, so make sure you check that video out as well. But now that there are 70 companies selling index universal life, that's gonna make it worse. And so moving forward, I think the volatility, I'd rather lock in and be a partner with a company that knows how to mitigate this risk rather than be a profit center for them. When you have a whole life policy, you're basically partnering with them. You're effectively a shareholder of the company. You get paid dividends for the success of the company, the profitability of the company. When you have an IUL, you're just doing what I showed you. And at the end of the day, whether you make money or lose money based on the call options, they're still charging you admin charges, fees, and the cost of insurance and all these different things. And based on the annual renewable term nature of the insurance, it gets really, really ugly as you get into your retirement years. And it doesn't take much. Once again, I did that other video on the cost of insurance. You're going to want to check that out. I'll put it on the end screen actually, because I think it'll be really, really beneficial for you to check it out. So if you have any questions about this, hopefully this kind of broke it down. I know it's a really complicated topic. I did my best to try to keep it as simple as possible. I encourage you to comment, engage with me, ask me any questions to get more clarity. I'm happy to make more content on this. There's a lot of people that like to make little 1-minute TikTok reels and whatever to make IULs look really sexy. This is the kind of stuff that you need to be seeing to really educate yourself. And if you see what I've said and you disagree with me and you think, hey, I'm not really worried about the options cost in the market. I think that the options budget's gonna go up, and I think the options market is gonna get cheaper, and you study it and you're comfortable with that. Once again, you should never put money into anything you don't understand. I'm giving you my opinion and my perspective because of what I believe, right? And I fully am aware that what I believe may not be what you believe, and that's okay. You got to align your money with your values and beliefs, and that's one of the things that I coach people to do. And if you are in alignment with my values and my beliefs, well then you're going to align with what I'm saying. And if you don't align with my values and beliefs, then you're going to look at this and you're going to Chris, thanks for the information. I will respectfully disagree, and you do you. And that's fine. And like, if you come to it from that conclusion, then you know what? I honor the fact that you are still maybe selling it, or you want to buy an IUL, and that's fine. But if you're just selling IUL on all the hype and all the noise that people on TikTok are saying and misleading people on, that's where I have a problem with IUL. It's not necessarily the product, it's the people that are misrepresenting it. It's the most misrepresented financial product in the world. And that is that. My rant is over. So if you haven't already, subscribe and hit the bell. Share this video out with an agent that you think would benefit from watching and learning from this, or somebody who is thinking about buying an IUL. I think it's one of the more clean videos that I've done on this topic. And that's it. Have a blessed, inspirational day. We'll talk soon. See ya.